702 Finance Feature.
9 minutes to 2 o'clock in our finance feature for today. We are talking about the oil prices moving faster than facts. And we are joined by Linda Eedes, who's investment executive at Foord. 011-883-0702 and the WhatsApp line 072-702-1702. Linda, welcome to the show. Thank you so much for joining us.
Good afternoon, Relebogile, and good afternoon to the listeners as well.
So let's talk about oil prices moving faster than facts. What exactly do we mean by that?
Well, Relebogile, we've seen oil prices moving all over the place since the start of the conflict. And we started the year at around $60. Of course, we saw oil prices move above $100 in March when it all sort of broke out. Peaked over $120 and then fell all the way back to $70 in early July when we had the sort of so-called ceasefire. And then more last in the last week, it spiked back over $100. And now over the last few days, back down to $84. So we've seen a huge amount of volatility in the oil price. And our point is that really that's been driven by short-term headlines and sentiment, and that the physical flow of oil is going to take much longer to restore. And I think the bottom line is that even if the straits open up entirely, which it doesn't look like that's going to be the case anytime soon, tankers still need to be persuaded to pass through, the lines need to be cleared, insurers need to be cutting insurance premiums, and the infrastructure that was damaged also needs to be repaired. And in addition to that, countries which of course have drawn down their sort of strategic reserves while all of this has been happening, that also needs to be replenished. So our point is that it is going to take some time for oil prices to normalize. We don't think that's going to happen anytime soon. So both consumers and investors alike have to think about pricing in a higher oil price as we sort of work through that underlying physical flow of oil and fixing that as it was prior to all of the conflict.
So in essence, the behavior is not being determined by real-time truth and facts.
Correct. And isn't that always the case with markets? You know, as investors, we have to separate the short-term movements, which are driven a lot by sentiment and what everyone is expecting to happen over the short term, and what is actually happening on the ground from a fundamental perspective. Because, of course, we have to make our decisions based on sort of the longer-term movement and the more sort of sustainable movement rather than the sort of knee-jerk reactions that we see day to day.
So what should the average South African be paying attention to in all of this? Because, of course, what happens to the oil price does affect us.
Of course. And so, unfortunately, it's not very good news in the sense that we do think oil prices are going to remain a bit higher for longer as we work through fixing all of those things which need to be fixed. And as I say, even if everything sort of evaporates in terms of the conflict overnight, it's still going to take some time to actually restore the physical flow of oil. So what does that mean? Well, the short-term good news is that we are probably going to get a very small decrease in the petrol price next week. As everyone probably knows, we have a monthly reset of the petrol and diesel price on the first Wednesday of every month. But the bad news is diesel prices are probably going to go back up. And we were hoping for a much bigger price cut in both of those things when prices were a little bit lower. Now they have sort of spiked and come back down. They use a calculation on a daily basis to work that out. But the short-term impact is that, unfortunately, we've seen petrol prices up 30%, since before the conflict. We've seen diesel prices up even more, 40%. And so that's going to have an impact on budgets, and it's going to have an impact on businesses. And then there's sort of knock-on effects as well. I mean, we saw the central bank, our SARB, actually didn't raise interest rates last week, which is a big surprise to us all because we've seen inflation picking up quite considerably. I mean, it's up at 5% now, and that's come up quite a lot over the last few months from 4%. So that's moving quite quickly. So they didn't raise rates, but of course it does mean that it's going to take some time for interest rate cuts to come through. So, higher inflation, unfortunately, potentially higher interest rates, and certainly higher portion of your budget that's going to go into filling up your cars as well.
Okay, and I think it's a lot for us to be super, super mindful of and to brace ourselves because we don't know what will be coming up. Linda, thank you so much for your time on our finance feature.